You are listening to Mining Stock Education.
I go to the gas pump here in Houston, Texas, and gasoline costs in US dollars. Go to Costco. I'm a big Costco fan, for better or for worse. And, even before the 5% discount or whatever from using the Costco card on gas, it's like $2.35 a gallon. And the last time that it was at that price, sustainably not during a pandemic, was 2006. So, this idea that oil is expensive and needs to go down, I think it's actually one of the biggest misses on the policy side for the Trump administration.
Welcome to Mining Stock Education. My name is Brian Lenny. Today with me, I have Josh Young, Chief Investment Officer at Bison, a fund focused on investment within the oil and gas sector. In this episode, you'll hear Josh's views on U.S. offshore drilling, the potential effects of tariffs on the Canadian oil market, the restocking of the U.S. strategic reserves, the contrast between higher oil prices and the cost of living, and much more. Josh, thank you for coming on the show. Let's start with the macro, specifically Trump's effect on the U.S. oil and gas market. He's revoked bans on offshore oil and gas development, opening up drilling along the U.S. coastlines. Plus, he's lifted restrictions on 2.8 million acres of the Arctic Ocean. In your view, is the potential renaissance of U.S. offshore drilling the key to Trump unleashing the U.S. oil and gas production on the world?
This is an easy one. No. It's a really good talking point, but honestly, it should have almost no impact on production. If it ever has an impact on production, it won't matter for the next several years.
Right. Okay. Just for clarity's sake, for the people listening, offshore, onshore, it does seem pretty straightforward what the difference is, but can you go through the difference and maybe what these revoked bans, what he's even talking about?
Yeah, so there's sort of a couple things that have affected, or a few things that have affected the current sort of drilling environment that I think it maybe makes sense to step back and talk about to be able to say why I could say sort of definitively that this particular thing, it doesn't seem to matter. It's getting a lot of press, but I don't think it matters. So the biggest factor is always commodity price, right? Like the higher oil is, the higher natural gas is in any particular area for that local realized price, the more private capital is going to look to deploy, whether it's, publicly traded companies using their money or whether it's, people putting together small drilling funds or whatever. You're going to see private capital chase high oil prices sort of no matter what. Then there's a question about availability where you need to be able to get that oil or gas out. So there was a real issue in the last few years in the US and in the last decade in Canada where the federal government and local state governments have been blocking new pipelines and new development and so on. And so that's a real sort of question and issue. And Trump is working on sort of undoing some of those constraints. And what you mentioned is sort of a first step towards that. But again, it's sort of, for a lot of these places, they just haven't seen activity for so long, if ever, that it'd be a decade from sort of first exploration to actually getting any sort of real production. And in most cases, they didn't see activity because there weren't obvious oil or gas deposits. So not in all cases, but in most cases for that. So it's just not as relevant. And then the last part would be sort of these actual sort of bans. So you have the question on price, you have the question on ability to access it, and then you have the question on sort of the right to be able to drill it. And where I think Trump will actually sort of make more of an impact is sort of on the regulatory aspects. So less are you banned from it and more, is OSHA going to show up and shut you down because someone cuts their finger on a rig floor or something? Are you going to get fined some giant amount for some very modest thing that no one would even notice if it was in a normal factory or if it was somewhere else, but because it's oil and gas? And this is true, as I understand, for mining as well in the US for a number of years now, you'd get sort of punished for being in this sort of industry that was out of favor. And so as they roll that back, that could help sort of restart or increase activity. But in the meantime, prices are so low for oil that you're actually seeing a global downturn in oil directed drilling. So you need to solve that first problem, I think, before you get a lot more drilling.
Right. What about U.S. tariffs? This whole situation, I know they've been delayed between Canada and the U.S. As a Canadian myself, there's been a lot of press on the various aspects of how it'll affect Canadian markets. But let's say it is implemented and the tariffs come into play. How would those affect Canadian oil producers moving forward?
So as I understand it, the proposed tariff on Canadian oil was 10% versus a proposed sort of broader tariff of 25% on other sorts of goods provided from Canada. And so at a 10% level, that's actually, if you take 10% and add it to the current oil differential for Canadian oil supplied to the US, I mean, it's frankly just within sort of the normal band of volatility. So I would actually expect almost no impact to the extent that the government of Canada doesn't impose sort of further restrictions or export taxes or what have you. So I actually think it's sort of not that big a deal. I think the bigger story on tariffs is, does Trump sort of stumble into or maybe intentionally trigger sort of a global trade war that slows down global economic activity? And so I think there's maybe more left tail risk to oil prices from tariffs because of that risk of trade war than there is right tail risk from, let's say, oil getting shut off from Canada or something like that.
Do the tariffs, do they make U.S. producers more attractive than Canadian producers?
I mean, people have tried to play this a lot of different ways. I'm not sure that it matters that much. We have a little more exposure right now to US producers than Canadian, mostly because I think the valuations actually converged. And in some cases, Canadian producers are more expensive. I'm sure there's a whole mob of people that'll get mad. The fact that there's a lot of people that might get mad about me saying that is probably a good indicator that it's not so cheap anymore. And then you're seeing these improvements in the US in terms of the regulatory environment and costs falling, relatively speaking. And things are still getting worse in Canada, unfortunately. Even with sort of individual provinces maybe going with sort of more ostensibly conservative governments, you actually still see, unfortunately, sort of a move towards more regulation, just slower. And so there's sort of this weird, that had been the case in the US for a long time, where there was sort of a uniparty. And frankly, in Canada, unfortunately, there's still sort of that, it's just this move towards socialism. It's just under the conservatives, it's slower, and under the liberals, it's faster. And these words are sort of weird in terms of how they name their parties. And so I think it's worth watching out for and being aware of. And again, it's not that I think that they're equal, right? Clearly, the slower you go towards socialism, the more economic value there is still to create. But it is a very big difference to be in a place where there's regulatory rollbacks versus increased regulations, or eliminating carbon taxes versus bragging about slowing the increase of them, which you're seeing in various allegedly ostensibly conservative provinces in Canada. And so I think there's a big advantage in being in a place that's liberalizing and that's reducing liabilities. And you can see it a little, it's played out a little more in Argentina, where the Argentinian stocks for oil and gas, as well as for the broader market, have done really well, as people finally realized that Milei would actually roll back a lot of these taxes and regulations and burdens and so on. And so you haven't seen that, unfortunately, in these Canadian provinces, that where some of the leaders say things similar to what Milei will say. And you're, I think, seeing the Trump 2.0, sort of this current administration, trying to do some of what Milei has done. And so I'm excited about that. And I think, relatively speaking, there's more upside in places where they're liberalizing and where that regulatory and tax burden seems likely to actually be going down rather than just going up slower.
Right. And actually, it's funny you say liberalizing. That's one of the words that's been stolen from the traditional conservative view. In Canada, the controlling party is the Liberal Party, and they're far more left of center than they are right. So it's funny how the words are stolen. But and this is sort of a political question next. What do you think the odds are of the U.S. going back to a restocking of their strategic reserve?
Yeah, I mean, so just to be clear, I was using sort of the John Stuart Mill, classical liberal, when I was saying liberalizing.
Yeah.
So that I'm in favor of and would bet on. And generally, you look at the performance of stock markets every time. People have these weird ideas, stock markets go up more in the US, for example, under Democrat administrations rather than Republican. But what you have is this weird thing where you have a lot of economic success under Republicans. You have a lot of sort of improvement of trajectory. And then so people feel a little better and more safe. And so then they're more willing to vote for, sharing the wealth and redistribution. So you end up with the periods of turnarounds being Republicans, unfortunately, and the periods of sort of more sort of reaping the rewards of those turnarounds being Democrats. But then, what is it they say? Good times lead to weak men and women, and then weak men and women lead to bad times, and bad times lead to strong people. And so there's sort of this vicious cycle. So yeah, I think there's a decent shot that Trump refills the SPR, at least to some extent. He's talked about it so far. They've actually done many of the things they said that they would do. And so I think it's probably a reasonable baseline to just, they used to say that you wanted to take Trump seriously, but not literally, but maybe you need to take both and just, roll with that for now. So yeah, I think there's a decent shot. Does it really matter for oil markets? I mean, I think like the surprise dump of the SPR after Russian sanctions weren't enforced and after the global economy went into a little bit of a slowdown in late 2022 really crushed the oil market, really hurt sentiment, and started sort of this derating of all the oil and gas stocks except sort of the very largest or sort of very specific special situations. So maybe you get sort of a reversal of that sentiment. But in terms of the global market, I'm not sure that it matters that much. And even if it did tighten the commercial market, the availability of an SPR actually, I think, dampens the ability for oil prices to go very high. So I'm not sure that it really, because it is still inventory, it's just not measured as commercial inventory. And so I think we saw when President Biden dumped the SPR and had a big price effect, I think we saw that could, reverse, and we've seen that. And I think what that does is it reloads to the extent Trump does go and buy oil. Maybe it'll push the price up 10 or 20 or something dollars, which is meaningful, but not, not I think what oil investors typically are playing for, which is sort of like a super spike. And so to the extent that he does that, it does actually reduce the risk of oil prices spiking and staying way higher. And so that's actually an economically valid reason to do it. And that's a reason why, as someone who's sort of structurally bullish oil through owning oil and gas producers, I mean, it's fine, right? It's good policy, but I don't know that it's necessarily that bullish as a oil equity investor.
Definitely, and I would say from the words that you're saying that higher oil prices seem to be what the future may hold. How do you contrast higher oil prices versus the real rise in the cost of living, which I went grocery shopping for the family last night. 100% groceries are up. It seemingly every month it costs just a little bit more to feed your family. So how do you contrast that against a rising oil price?
I go to the gas pump here in Houston, Texas, and gasoline costs in US dollars. Go to Costco. I'm a big Costco fan, for better or for worse. And, even before the 5% discount or whatever from using the Costco card on gas, it's like $2.35 a gallon. And the last time that it was at that price sustainably, not during a pandemic, was 2006. So, this idea that oil is expensive and needs to go down, I think it's actually one of the biggest misses on the policy side for the Trump administration. And it's sort of a very weird concept. People see these prices and they don't really know how to interpret them. And then, in certain places, so in various parts of Canada, there's very high taxes. In California, there's high taxes and regulations, which sort of double dip, and high real estate prices. So you end up with really weirdly artificially high gasoline prices. But it's very low. And I think, we put out something on how oil prices actually help. They help the Canadian economy even more than the US economy. But higher oil prices are really beneficial for the US economy. It leads to a lot of jobs. It sort of hits with more economic activity, but also because we're a net exporter, if you just do the math, it's real simple, right? If you sell more of something than you use, then the price of it going up leads to your economy doing better, right? I mean, it's like very, very simple concept. So yeah, I think prices are way too low for gasoline, and no one ever wants a consumer price to rise. But if you look at, eggs, even sort of the cheap ones are like $4 or $5 a dozen. They were $1 a dozen a few years ago. I mean, it's just sort of a giant disconnect, right? Like you could, in theory, see the equivalent of that with gasoline, where gas could be, let's say, $10 a gallon, which actually I think is sort of similar to what the price is in Canada right now. So at least,
Yeah, though it's $1.50 in Ontario, right, or where I live in Ontario right now, and so that's what roughly.
But that's a liter.
That's a liter, yeah. So that's like 6 something a gallon, which is a big difference from the US. But it was interesting. I'll tell you, Josh, because my family and I vacationed in, I don't know if it's necessarily called the Midwest, but Montana, Wyoming, and the Dakotas last fall. And I was surprised to see for the first time in my life of going down into the States that food prices were somewhat equivalent or maybe even a little bit more expensive in those states than it was back home. And that's in US dollars terms. And so I'm not really sure if that's an oil thing or how that contrast really has been made up between the States and Canada, because growing up, the States was always cheaper, even with the exchange. So it's interesting.
Yeah, I think that's really just so I sort of like told the story around it, but yeah, the specifics are that household goods are roughly 2 to 3 times as expensive at sort of normal stores or whatever than they were, let's say, 15 to 20 years ago, and gasoline is about the same price as it was at that point, at least in the US, before measuring additional taxes, so on sort of a tax equivalent basis. And so, yeah, there's a lot of room for gasoline prices to be higher without having a disproportionate move on sort of the ability for households to afford them. And there's a reality, which is after the COVID super inflation from, printing money and making everyone stay at home and all these economic distortions, there's I think households have shown much more ability to flex around affording certain items over other items or whatever, navigating big price movements that were atypical versus the recent history, US, Canada, and various other Western countries. And so I don't think there's a real affordability issue for gasoline, and it is one of those weird things. I think it's just because you don't see like the price of bananas or the price of eggs when you're driving down the street posted everywhere. And so I think it's the gasoline price, but people just don't get it. So anyway, it's a great point. It's really important to think about because there's just so much room to the upside, and oil prices are so suppressed, I think partly because the politicians and sort of regulators, everyone knows this. And I think when you think about commodities, the higher the price of a commodity is on a real basis, the more people invest to produce more of it. And the lower the price is, the less people invest to produce more of it. And we're finally seeing that. I mean, the global oil rig count is down a lot, and the US oil rig count is down a lot. And so, I think you can sort of look at that as a proxy for what's sort of the break-even price, or what price you need at least to get sustaining development and activity. And I think that answer is way higher. And you can just see it by thinking about your own personal household goods. Like, what do you spend money on, and how much more expensive is it than it was 15 years ago? And then, oh, hey, gasoline is actually cheaper than it was 15 years ago.
Right. In terms of the numbers of rigs out there, is that fully a oil cost or price thing? I've heard some commentators talk about the number of rigs being linked to the more the geological, the potential, like all the best wells and fields in the States. Mainly, this is what the talking point is, that the fields and the wells in the States have sort of peaked, and we've reached peak US production. Would you concur with that?
I think we've reached peak US production for $70 oil. And so I think there's sort of this there's this weird sort of Malthusian tension where we're always running out of the cheapest oil, and we're always seeing new technologies and new sort of search methods to find new fields and improving ability to extract oil out of existing fields. Similar to various mining resources and various other things. There's always this tension. So there's periods of time where there's a lot of money spent on research and development, or there's a lot of money spent on sort of building efficiencies, and there's periods of time where there's material underinvestment. And we're at the very end, I think, of a very long oil capital cycle where we saw huge investments in oil field services, huge investments first in exploration, let's say from 2001 to 2014. And then you saw this next wave of investment in efficiency and well productivity and so on, especially on unconventional, particularly in the US, over the next, let's say, 10 years or so. And so we're at a point you can actually look at this in terms of global oil field services CapEx, which we actually think is sort of it's almost like measuring the second derivative on global oil CapEx, because you need to spend the money on the services before you can spend the money on the drilling and the production and development. And so we're at this point where we've sort of burned the furniture, both on exploration and on services efficiencies. And so it's not that we're out of oil, it's that we're out of cheap oil and we're out of cheap rigs and we're out of cheap pressure pumping. There's this weird conundrum. Very recently, the largest land driller, H&P, excellent company, they reported and they disappointed and their stock was down a lot in one day. And when you look at what happens there, right? So that sounds bad, right? It's, oh, is that bearish oil? Is that telling you there's some big problem? It's amazing. Their margins are as good as they've been in many years. I mean, very slightly better in 2022 than now. But like, if you look at their 10-year history, their margins are excellent. There's just not that many rigs that are going to work. And if you think about what it means for there to be low utilization, but high margins and services, that just tells you that like everyone's burned the furniture. There's not 200 more rigs to go throw on. And they talked about a little in their quarterly report and in some of their guidance. And they talk about it. They think eventually, whether it's this year, next year, you're going to see a big pickup in the rig count because there is this underinvestment. And they claim they have a bunch of rigs waiting. But if you look at their CapEx numbers, I think they have some, right? I'm not saying they don't have any, but when you think about them and their competitors, there's just been this incentive to allow rigs to go into disrepair, to cannibalize them and reduce the available rig count. And so it's not that you can't go put, let's say, 200 more rigs in West Texas, Southeast New Mexico, North Dakota, a few other spots and get more oil. It's that those rigs aren't really available. So it'll take a while to do it. And you probably need $100 plus, maybe $120 oil to really incentivize the producers to go do that sort of activity. And so that's where like the political stuff is sort of funny to talk about and fun. But the reality is you want drill, baby, drill. If you're Trump, you've got to either like massively incentivize producers to drill via tax credits and all kinds of stuff that's not really his sort of ethos, or you just need much higher prices. And so I don't think it's a geologic thing because there are always these efficiencies and always these improvements. It's more just, I think, a numbers game at this point. I think we're not at peak rig efficiency, but I think that second derivative has gone very negative, where efficiency gains on drilling are slowing a lot, efficiency gains on fracking are slowing a lot. And so I think you're just going to need this next leg, which is, I think it's going to be higher prices, both for oil and gas, and then much higher activity levels. And so, I think it's set up really nicely, but the political stuff is just sort of like, it's almost funny in terms of showing how little even their brilliant advisors really understand the industry, and then how little the politicians get it. You see both sides, like they're arguing with each other about who's going to lower oil prices more. And it's like, guys, it sort of doesn't matter. There's a geologic and physical reality. You need more rigs running, or you're just going to have even higher prices and you'll all be sad.
In a recent Bison Interest email to subscribers, you put forth a bullish case for natural gas. Natural gas is notoriously volatile and definitely can be challenging to invest in. What sort of companies are you looking at investing in?
Okay, so we have sort of two profiles of companies that we're most excited about, and I'll share one name, which is going to sound a little funny given what I just talked about. So the two profiles are. We really like these producers that produce a lot of natural gas, but also some oil and natural gas liquids. And we like them because their valuations are very low. And in many cases, they offer, because they're so cheap, they offer similar cash flow upside to higher natural gas prices to some of the sort of pure play natural gas producers that trade at much higher valuations. So you look at XYZ small cap hybrid producer that's like a third gas, oil, and NGLs. And they might actually have the same cash flow upside as like an EQT or Range Resources or an Antero, but you get them for, let's say, 2 times cash flow instead of 6 times cash flow. And if oil prices go up, you make money too, or if natural gas liquids prices go up, you make a lot of money too. So there's a lot more, I think, embedded value in these small caps. And I think there's also more of a margin of safety where you can make money sort of from multiple different production streams. And I think you saw the large caps go up on the AI narrative and on sort of this big sort of natural gas investment push. And I get it, right? Because like stock goes up, people buy stock, goes up more. There's sort of this weird sort of circular, almost like flywheel thing that goes on with stocks in the short term. But over time, the market is a weighing machine, and we way rather buy something at 2 times cash flow with like 30% free cash flow yield that has the same upside. Natural gas goes to 6 from 3, right? They'll make proportionally just as much more money as some of these dry gas producers, but they're starting at 2 times instead of starting at 6 times. And if oil goes up a lot, we'll make a lot more money. And if oil doesn't, then we still, there's more ways to win. And I found doing this for as long as I have, and we've been running Bison for 10 years now, really important to have multiple paths to success. And I think people are I think natural gas is a screaming buy. I mean, just the supply demand setup is so overwhelmingly compelling, but I think it's also important, even when you're really excited about things, to make sure that you're not going to lose too much if that thing takes longer or, something happens that you can't expect or don't expect or so on. So that's one profile. The other profile is we think that there's way too little investment in oil field services. And actually, similar to the producers, the drilling rig companies and some of the other service lines are massively undersupplied, right? There's just too few rigs running in order to be able to maintain oil production, but also too few rigs running to be able to supply the LNG export facilities and to supply the data centers and so on that are getting built out. And so I actually don't know. I think is going to be in a Bloomberg article potentially soon, but this may be the first moment that we're formally disclosing this. So we've bought a ton of this company, Ensign Drilling, and they're Canadian driller, but they have most of their activity in the US and international. And their chairman is famous. And it's really funny because everyone will talk about him because he's the chairman of Canadian Natural Resources, which is this giant producer. And everyone says, oh, they're the best company ever. But, him and Mike Rose and maybe 1 or 2 other people are like famous as the best capital allocators. And here he is as the essentially control 30% shareholder and chairman of Ensign. And no one talks about it. You don't hear Murray Edwards click her heels 3 times, the stock goes up, sort of like Tourmaline or some of these other things, or even like him with Canadian Natural Resources. And so you have this thing, it's very cheap. It's very levered to higher natural gas prices and to higher oil prices. And I guess just the one other thing about it that's just so interesting is, and we've written about this, just never with disclosing specific names. This is one of a basket that we have like this, where as a value investor, especially a deep value investor, you look for companies at a very large discount to replacement cost. Because if they have things that are going to be needed and are needed over time, eventually, if you buy it for cheap enough, the price of the thing and the margin on the thing needs to go high enough that it makes sense to replace the things that are being used. So whether it's housing, like, 2008, you wanted to go buy a house, 2009, because you can buy them for a fraction of what it costs to build a new one. And eventually you knew house prices would go up, and house prices have doubled, or in Canada, they've gone up 5x or something crazy, but depending on the market. But you have these drilling rig companies, some of them like Ensign, at a particularly large discount to replacement cost. And almost never in stock markets do you get to buy things at a big discount to replacement cost that are also generating a lot of cash flow and a lot of free cash flow. And so this sort of combination of discount to replacement cost and very low EBITDA and very high free cash flow yield is ultra rare. And so getting that with a famous sort of top 1% sort of chairman who just put more money into the company, who is sort of an owner operator running this thing. And where you have, getting back to the question, what do you like most for natural gas? This thing, if you get what we think, which is, let's say, $5 plus natural gas in North America, you're going to see a lot more rigs running. And the companies that win the most from that are the ones that are the cheapest, that have the most available rigs to be able to bring on. And then there's the last thing, which is they have a lot of debt, and people don't like companies with a lot of debt. And I think this is partly why they forgot that Murray Edwards controls this thing and is the chairman of it and owns so much of it. But if you think about it like a leveraged buyout, right? Leveraged buyouts don't have that bad name. Over-levered public companies have a bad sort of reputation, but leveraged buyouts is what private equity funds do. There's this race to put money in the largest private equity funds, the Blackstones and KKRs and Apollos. They're raising record large funds. Here you have someone who they would die to give $10 billion to go buy something, right? Murray Edwards, amazing track record, been around forever, done incredibly well. He would have no trouble, in my assessment, accessing private market capital to go do a leverage buyout of a company. But this is even better. It's a public thing, so you don't have to go deal with the illiquidity and you don't have to go pay the price that people would pay in the private market to buy a business like this. And so you have this essentially leverage buyout controlled by a top 1% capital allocator in the oil and gas space, right? Who is associated with this very high valuation, very large cap producer. And you have it at less than 3 times EBITDA, like 40-something% free cash flow to the market cap. And they're paying off $200 million of debt a year out of the $1 billion of debt right now. And so they're very quickly going to be from an over-levered company to appropriately or under-levered company. And the market cap's only around $500 million. So you're literally paying off 40-50% of the market cap in debt every year. And as soon as they flip from that to buybacks and dividends, you're talking about, 40% plus or minus at current depressed rig rates and utilization. So if you get to this point that H&P or these other rig providers expect, or you just get, $5 plus gas, I mean, you could have this thing easily go to 100% plus free cash flow yield to the current market cap. And the way you underwrite all of that is basically, hey, what's the replacement cost? It probably goes above that. And $3 stock plus or minus versus $15 plus estimated replacement cost before factoring in recent inflation. So anyway, that's my favorite way to play this, maybe by a lot. And maybe your Canadian viewers will find this particularly interesting.
Talking about debt to cash, and I think the ratio you gave with that company specifically was around 5-1, $200 million pay off a year on $1 billion debt. When it comes to actual cash holdings and maybe not necessarily cash flow, can you talk to us more about debt to cash levels and what you like to see? I know it can be sort of company by company basis, but generally speaking, what about debt to cash?
Yeah. So debt to cash flow or debt to cash on balance sheet?
I would say on the balance sheet, because I think I tend to look at things more conservatively, especially when it comes to my experiences have sort of led me that way, is being more conservative in terms of looking at what they actually have and not getting too caught up in what they might be able to cash flow in the future.
Yeah, for sure. And again, it depends on the stage of company and depends on sort of what they do. So with Ensign, where it's a active, leading drilling rig company in multiple different markets in the world, including in Canada and the US, and where they've been in business for a long time, and they have a billionaire as their largest holder and financial backer. And then they had Fairfax as the second largest shareholder, but buying a ton of the stock recently, putting money in. It's a little different, I think, than sort of a typical situation. My preference is really very little debt by producers or for upstream companies and also for services companies, or a lot of contracts or hedges to sort of support debt pay downs. So in Ensign's case, they don't have a ton of long-term contracts because that's not really sort of how the business works so much, but they have a number of customers where they've worked at them for a long time, and there's a reinvestment requirement by those customers on their fields where, it's the downside of shale is that you need to drill a lot in order to keep your production flat. The upside of shale is if you're a service company and you service that means even if you don't have a long-term contract, you may be able to just, if you don't mess it up, right? There's actually a lot of negatives if you try to switch drilling rig providers. There's a lot of risk and uncertainty. So if you provide good or excellent service as a rig provider, you're likely to be on a rig on a location for a long time, absent a huge shift in commodity prices. So there's not as much long-term contract coverage as I would like. But there's other mitigators for this particular one. But yeah, in general, we're looking for companies at sort of less than 2 times debt to cash flow on sort of mid-cycle levels. And in this case, so I use just the free cash flow number, which was sort of around $200 million, but their EBITDA is close to $500 million a year. And so, Ensign's only at roughly 2 times debt to cash flow on a debt to operating cash flow, debt to EBITDA. And they are sort of paying that down a lot, but that's sort of on the upper end of where we'll go. And in some cases, we actually own companies that have large net cash balances. So they either have no debt or they're actually sitting on a bunch of cash. And there you have the same problem, but sort of inverse, where, if you own a $500 million market cap company and they have $100 million of cash and they're paying a dividend, they're buying stuff and they're growing, great. But boom, why are they sitting on that cash? So shouldn't they give that to you or do a big buyback or something? And so, sitting on cash can be advantageous, but it also can weigh on returns. So that's sort of the spectrum, anywhere from companies that are net cash positive to, having some debt. And then, all of those are within the producing or, providing services and generating cash flow right now stage. None of these we have very little exposure to exploration companies or companies that aren't currently generating a lot of cash flow. If we did, we'd look for companies with a lot of net cash and no debt, because borrowing money to explore is a recipe for disaster.
Right. And this may be what you were describing with this pick, but in the hard rock or in mining industry, we usually refer to optionality as high cost producers. And in bull markets or in rising price environments, metal price environments, this optionality can be great because that margin grows so much more than it does with the low cost. Parlaying this to the oil market, with the projected higher oil price ahead, is it time to start buying optionality?
I mean, I think you always want to have optionality, and frankly, when it's very popular, often it's sort of too expensive. So I'd say one of my mistakes in 2022, I did cut back on some of my positions that had sort of more of that right tail optionality. When it started to go into the money, I think the right way to do it is to sell it. And so, we sold some of it, but didn't sell enough. And I think for this, you have a lot of that sort of right tail exposure. And I do think, I remember I was chatting with the CEO of a different drilling rig company, and we came up with this term called rigpocalypse, which is basically you're going to get to a point where you add an additional rig and you don't actually add much volume, because when you add the rig, your rig efficiencies don't necessarily improve. They might actually fall because it's sort of a new crew and it's a new location. And maybe you add 10 rigs right across an area, or not just one producer, but West Texas producers. Maybe they had 10 rigs, maybe they had 100 rigs over a year or two. You could actually end up with sort of the equivalent of diseconomies of scale. You'd have you have reductions in efficiencies. And so what happens when you add that incremental rig or incremental set of rigs, you add that incremental frac stack or set of frac stacks, and you don't get more production. And this happened. This gentleman was older. He had actually joined the industry on the tail of this happening in the 1970s, where you saw a surge in drilling rig activity. And I show these long-term charts on drilling rigs and people get mad. They're like, oh, it's not like the 70s. And it's like, well, that's what everyone said in the 60s. They said, oh, things were great and drilling rig efficiency was improving and people drilled more feet at lower cost and things were wonderful. And there was this great story. And just like, we're not in nirvana, we're also not in Malthusian hell, right? There's somewhere in the middle, and you can't get too excited about sort of either of those. And so there isn't this sort of drilling rig, utopia where drilling rigs get more and more efficient forever. And you go to there's this joke about the mono rig where there'll be one rig operating in North America, drilling all the wells because they're so fast. So as we get back to that sort of problem, right, which is you get too efficient and you're just not able to sort of replicate that. And as you add rigs and add production, there's a risk that you have to go from way fewer rigs to way more rigs. And it's going to be an interesting question to see sort of how the commodity prices play. through all of that. And we've been repositioning some of our portfolio to sort of be better exposed to this. I know it sounds sort of wacky, but like we're seeing early signs of it. You're seeing people worried about the geology and worried about sort of remaining inventory in various plays. You're seeing physical shortages in places that you shouldn't really be seeing them. And then you're seeing the drilling rig companies, including, the RMPs or whatever, talking about how they're sort of underinvesting and how you can see their active rig count falling and their, the warm stacked rigs, the ones available to come on, being reduced. And so I think we're set up really nicely to potentially have this sort of 1970s type surge in drilling activity, which may not be accompanied by a giant surge in production. And so, I don't 100% know what the price path would be on that, other than you probably need higher oil and gas prices, but do you need $85 oil or do you need 120? We'll see somewhere in there, and you probably need $5 plus gas. And don't believe me, go ask the CEO of Expand, which is the largest publicly traded natural gas producer, and ask the CEO of Aethon, which is the largest private natural gas producer, and they both think you need $5 plus to get a bunch more rigs running. So yes, I agree. I think it makes sense to try to go for that sort of tail exposure. At the same time, again, one of these sort of important lessons that they say you never really learn anything, right? Like the fund manager from Duquesne, who now runs sort of just his own money, he talked about how he bought a bunch of tech stocks at the very peak of the .com boom in early 2000. Why do you do it? I don't know. He just got sucked into it. It's really, really hard. So that being said, it's still important to try to learn something. And so I think it's important to try to get that very big margin of safety where possible. And when I look at something like an Ensign, where there's just this giant amount of replacement value, and then billionaires and giant investment funds for whom this is a rounding error, who are dying to put capital, and they just did a $25 million convert they wanted to make sure that everything was just conforming. And so they put a tiny convert in at a high price, high conversion price, and they did it like overnight, unbrokered, and it was Murray Edwards, the management team, in Fairfax. And so, honestly, I felt very, very slightly upset about it, because oh, hey, what are they doing? Are they ripping off the shareholders? And then it was like, well, no, they've added Murray Edwards, it looks like, just through his involvement and managing the company well and so on. They were able to do a second lien loan a few years ago. That's the debt they've been paying off and rapidly amortizing. They did it at like a 8% interest rate, when I think the expectation was it was going to be at a 15% rate. So if you just look at the interest savings, it sort of more than makes up for whatever little amount they put in. But when you have large, well-capitalized groups dying to put more money in the thing as the debt level is, collapsing relatively quickly, I think that's indicative of a very nice margin of safety. That's not just sort of the financial math. It's also like you can observe large pools of capital trying to get into this relatively small thing from a market cap perspective that's very, very large from an asset perspective, and very large from a sort of cash generation potential perspective. So lots of upside, but also you have the financial aspect of the downside protection, and then you also have sort of the people and sort of pools of capital looking to get into this aspect that I think offers some more protection too. So important, I think, to look down as well as look up to make sure that you don't get destroyed on stuff in the oil and gas space.
Right. And so the last few years we had the spike in 2020, and then we've had a couple of marginal or downtrodden years, I would say. You mentioned two things. You mentioned you didn't sell enough, and then you talked about protecting your downside. Looking forward into whatever market is ahead of you, those lessons that you did learn when it comes to, is it needing to sell more when the peak of that bull market hits? Is that the biggest thing that you need to change moving forward? Or is it, the outline of the downside protection you have with this new investment? Is that what you're going to be projecting forward? What's that biggest lesson learned from the last cycle?
Yeah. So I think during periods where these things are out of favor, it makes sense to buy more marginal producers and buy more marginal service providers, buy ones that have a little more debt, buy ones that have a little sort of thinner margins. And I think one of the lessons from 2022, for me at least, is, okay, at the point where you start to get that optionality priced in, maybe before it's fully priced in, trim some of that exposure and add more to some of the producers, some of the services companies that have sort of improved margins, especially, so let's pick on Ensign, right? So Ensign in 2022 took their extra free cash flow, and instead of paying down debt, they paid down the amount they were supposed to pay down, but then they reactivated more rigs. And that was a very pro-cyclical play. And it turned out to be wrong, because then they had to turn off those rigs, a year and a half later, right? They're back down. They kept a few of them running, but not as many as they thought or anyone would have thought, right? And so that sort of investment is more risky. Had they taken that extra few $100 million and not spent it on rig reactivations and spent it on debt pay down, it'd probably be a $10 stock right now instead of a $3 stock. And so that's bad for them and for folks that I owned a little bit of the stock there. We've added a lot recently. But it's bad for folks that held it then, and it's great for now. And I think when you talk to them, they acknowledge it. They say, yeah, we should have spent less money on rig reactivations. And if you look at that path, there's the potential for companies like Ensign to go from sort of more marginal, more sort of right tail exposed and sort of like super levered to the upside on multiple different metrics. There's room for them just through pure deleveraging and through proper sort of capital allocation to actually transform themselves from a higher risk but higher reward sort of setup to a company that offers sort of less share volatility and less downside risk purely through debt reduction. So as they go from $1 billion in debt to potentially, let's say, $500 million through debt over the next, let's say, 2.5 years, I think they end up converting from a company that's perceived as higher risk. And again, I walked through why I think it's not quite as high risk, to a company that is not perceived as a high risk. And, if you think about, you pay off $500 million of 8% interest debt, you got an extra $40 million a year free cash flow, or at least money that doesn't need to go just to interest payments. So, that's really helpful if you think about sort of your extra margin of safety if a rig count falls again, or if, day rates fall or so on. So, I think it's either sell the companies that are just sort of structurally lower margin as they experience sort of bonanza profits and up cycles, and or make sure that the companies that do have those lower margins are doing the things necessary in order to expand their margins, and then, hold those stocks, or maybe even buy more of them, because everyone, like, part of why we didn't sell was everyone was so hesitant to buy these things that it wasn't like the highly levered ones had, or the more torqued ones had crazy high valuations. They just, they had gone up a lot because the commodities had gone up and the service levels, the activity levels had gone up, but they hadn't quite gotten to what I think would be fair value. But I think being better about finding the things that are sort of continuing on that value unlock and that are moving towards being sort of more down the middle, or even high quality, highest margin, safest. I think that transition, there's a lot of value to unlock. And there were companies that were successful at that, some of which we owned and maybe sold too early, some of which we owned and still own, and it's been great, and some of which we didn't own at all. And so you can see that path, and those companies have done phenomenally well for their shareholders. And so my lesson is, hey, there's no reason just to watch that or to sell those early. If they're doing the right thing, you can own some of these things for a long time, and they offer a lot of upside and less volatile paths as they sort of progress on that value creation and risk unlock. And so this Ensign, for example, I think it's possible we could end up owning it for multiple years as they pay off their debt, as the rig count rises, as rig rates rise, as people appreciate more both who's there and the discount to replacement cost. You could see it go through multiple re-rates as it goes to, let's say, a reasonable value on current free cash flow, let's say $7 a share or something, gets them down to like a 20% free cash flow yield with the market cap. And then as they pay off more debt, maybe they get another couple dollars a share a year just from the Miller-Modigliani sort of like, as you pay off debt, you get a similar amount of market cap upside. So that's sort of the thought. Anyway, long answer to the question of, hey, like, what would you do do differently. And I think it's really important to be able to look at those things and to be able to consider, I think all of us are imperfect and every sort of investment approach is imperfect. And, we stayed in business over multiple different oil downturns through figuring these things out and trying to better position each time. And sometimes we've done a lot better than the market and sometimes a lot worse. And I think as you think about these things and as you sort of reposition and get better, there is that potential. Over the 10 years, we've done way better than the small cap oil and gas index. And so there's that potential to do that, but you have to be able to check your ego at the door and say, hey, okay, like what I do right, what I do wrong, and like, how do I not do as much wrong? Knowing you always do stuff wrong. It's impossible. Like Drucker Miller was saying, like it's impossible to like do what you ever really learn. I don't know, but like you can at least make fewer mistakes like that, cut them sooner, redeploy faster, and then where necessary, get sort of more active with the companies in order to sort of force or encourage that unlock of value.
Are the oil and natural gas prices the biggest risk to the Bison portfolio in 2025?
That's a good question. I think there's that's a real risk. I think there's a risk that things in Canada get a lot worse. The parliament is prorogued, which is a word I learned a month or so ago when Trudeau said he resigned but didn't. And so I think there's actually really a lot of left tail risk in Canada, unfortunately. This looks really similar. And like, this is maybe the Canadians will get super mad at me for saying this, but this looks really similar to what's happened in other sort of Commonwealth style countries as they go into situations where they have no election for a number of years, where they have people who are deeply unpopular, but have sort of different levels of control via military, via civil society, whatever. And, I think there's a lot of risk that you have sort of this like dig in of the Liberal Party in Canada. And, where they've done that already in terms of cracking down on civil liberties and on truckers and various other things, there hasn't been that sort of popular rejection. And so, in the US, there was that popular rejection. A lot of these things were sort of forced back. The leadership of states and governors like DeSantis and Abbott and Florida and Texas really sort of forced the US back from the precipice of some of this sort of totalitarian stuff. And so I know it sounds very political, but I think there's a real risk that things get a lot worse. And a lot of it's sort of like fake, where, in response to tariffs, you had the Liberal Party supposedly in Canada being pro-pipeline or whatever. You have various like hangers on saying, oh yeah, like we're going to build pipes. It's complete BS. And you can tell, like, even like when they're off camera or like off script, you hear the Quebec politicians stuff saying, yeah, that's never happening. But they're telling you it still while it's going on, that they don't believe it and it's not happening. So there is a lot of risk, I think, on the Canadian side. And we do have a lot of exposure in Canada. We have more in the US because of this transition and liberalization in the US. But there is a lot of left tail risk, I think, in Canada from a jurisdiction perspective. And the stocks are very cheap, and I'm optimistic that it is overcome and that you have a sort of better leadership that hopefully actually does roll back some of these taxes and regulations. But there is a risk, when I think about, hey, like, what do I think might happen that I could see now that's not a black swan? It would be that there would be sort of more bad stuff from a regulatory and political perspective that could sort of further derate Canadian companies. And then just real quick on Ensign, I'll tie it back to that. Their majority of their revenue and operations are actually outside of Canada. And it's been one of these fascinating things where the Canadian dollar will fall. And so their cash flow rises because it's denominated in US dollars on the bulk of their cash flow. And they have some US dollar denominated debt and some Canadian dollar denominated debt. And part of the convert was there was some foreign exchange issue where they wanted to show a certain leverage level with their second lien in order to stay conforming. They didn't want to have to get a covenant waiver because there was risk of more volatility, and their largest two shareholders were dying to put money in. So was it pull or push? Unclear, but it made sense in terms of that weird foreign exchange stuff. Just the end of year, there was a big move down on the Canadian dollar, and so it made things look a little funny. But they're actually a big beneficiary of sort of further dysfunction in Canada. And so to the extent that the Canadian dollar falls more, even if, let's say, drilling activity slows in Canada and picks up in the US, for example, Ensign could end up actually being net a pretty big winner. And then the replacement value, I think the right way to think about it is denominated in US dollars and not Canadian dollars. You're not really building rigs in Canada. Frankly, you're not really building them anywhere. But a lot of the inputs are dollar-denominated commodities and dollar-denominated labor. And so I think you could end up seeing a sort of downside scenario for some of these Canadian companies, but actually see upside to some of the stocks. And so anyway, I think they're actually pretty well hedged to the downside. And then on the upside, I think there is this bright light, right? So that's a risk, but there's also this opportunity, which is hopefully there's an election, and Polymarket says there's an 81% chance that Pierre Poilievre will win. I would probably mispronounce his name. I apologize. But if that happens, I think you end up with a rollback in regulations, hopefully, and a surge in the Canadian stock market, I think generally, and particularly in the natural resources space, particularly oil and gas. And so I think you actually see this scenario where things get much worse in Canada and Ensign could do well because of their foreign operations and US and international, and things get better in Canada. And I'm not sure what happens to the Canadian dollar. Maybe it improves, maybe it doesn't. I'm actually not sure what Poilievre prime ministership will do to that. But there is this potential of this surge in the Canadian market, and Ensign does have a lot of exposure. I guess that's the benefit of all this debt and low market cap. Relative to their market cap, they have a lot of exposure to the Canadian industry, and they have a lot of exposure to international and US. And so when you look for companies that would be the biggest winners from a Pierre Poilievre win, Ensign might be one of the biggest winners, but it's also potentially one of the biggest winners if things get terrible in Canada. Again, I hope that doesn't happen because of their large non-Canadian exposure and having a lot of Canadian dollar denominated debt and being a Canadian traded stock. And so you actually have this sort of weird thing where it could work really well. It'll work better for them if Poilievre wins. But it is a risk, I think, broadly for my portfolio, even though I think actually Ensign could weirdly do well in both of those scenarios and end up sort of maybe navigating it well where they end up winning if elections are delayed further and the Canadian dollar falls more, and they just the dollars that they make end up being worth even more, and they can pay off even more Canadian dollar debt. And then, hopefully then there's a change in leadership and there's an election and there's a sort of peaceful transition of power. Hopefully that leads to a sort of re-rate of Canadian stocks broadly. And I think they could be, at least from current levels, one of the biggest winners of that sort of peaceful transition, and then re-rating higher of Canadian natural resources stocks.
Josh, how can the viewers find out more about Bison Interests and yourself?
Yeah, easy. Go to bisoninterest.com. We're always happy to chat with people. Run a fund. None of this is meant as a solicitation or recommendation or anything like that. But for accredited investors who are interested, we're happy to chat about that. And like you mentioned, we just give away our research, and so we're happy to have people join our mailing list and share sort of what our latest thoughts are on the industry.
Excellent. I really enjoyed the chat, Josh, and hopefully you can do it again soon.
Yeah, thanks a lot, Brian. I really appreciate it.